I published my weekly blog post earlier today that discusses my recent security transactions. I'm continuing to sell into the stock market rally that has occurred after the election results were known. I was selling even before the election fairly heavily. I did participate in today's 4-month Treasury bill auction, which is 119 days, a trade that I will discuss in my next weekly post. The investment rate was 4.517% with the bill maturing on April 1st, 2025. I will also be buying the 6-month bill at next Monday's auction, probably 5,000 devoted to that one, but I may go as high as 10,000 in my Schwab account, where the sweep account that Schwab has pays only 0.1%. The personal consumption expenditure price and inflation index was reported earlier today, and it was in line with the consensus estimates that I mentioned in yesterday's post. While the inflation number has been trending down since hitting a high in 2023, the annual inflation numbers did increase to 2.3% for PCE price inflation, up from 2.1% for the 12 months ending in September, with the annual core inflation moving up 0.1% to 2.8%. I'm not sure why the bond ghouls are celebrating those numbers with interest rates moving down. As of 11:30 a.m. Central Standard Time today, November 27th, the yield of the 10-year Treasury note is at 4.24%, down 7 basis points. As of the same time, the odds of a 25 basis point cut in the federal funds range at the December 18th Federal Reserve meeting, as reflected in the CME FedWatch tool, has risen to 70% from 59.4% yesterday. With the 4-month bill investment rate at 4.517%, which is above the current federal funds low range, I do not see that yield confirming a Fed rate cut at all in December, and certainly not at a 90% probability. Personally, if I had a vote at the Fed, I would vote against an increase unless the next jobs report is just really awful. Inflation is not dead, in my opinion, and may be resurrected fairly easily into problematic territory over the next year or so. The Fed already made the second most serious monetary policy mistake in its history by allowing inflation to surge in 2021, keeping their foot to the pedal to the metal, as the saying goes, on extremely monetary stimulus policies with ZIRP and QE, quantitative easing, continuing into March 2022. The biggest mistake that the Fed has ever made occurred after the 1929 stock market crash, when the Fed tightened credit and shrunk the money supply. An incredibly stupid response to what was happening in the economy. That turned, along with a trade war started by Congress by the passage of the Smoot-Hawley tariffs increases and the lack of any insurance for bank deposits at that time, turned a serious recession into a long depression. Also noted earlier today that some of the Treasury notes that I have been buying in the secondary market maturing in October 2025 through January 2026 timeframe have moved down about 5 basis points in their YTMs over the past day. Maybe the bond ghouls were worried that the PCE inflation numbers would be worse. It's hard to explain their reaction, but it doesn't have to make any sense. The PCE price index and the second revised GDP report released earlier today for the third quarter, which is July through September 2024, had the core PCE inflation at 2.1%. So is it moving higher now? Real GDP growth was unchanged at an annual 2.8%, which is okay for the U.S. economy. It's not too hot, not too cold, just about right. In a recent video, I argued that the conditions are now ripe and will likely continue to be so for the start of a long-term bear market in U.S. bonds, similar to what happened in the 1950 to 1982 long-term secular bear market for bonds, but in my opinion, more likely to start in its catastrophic phase sooner than that earlier period. The catastrophic phase of that earlier bear market started in the 1970s. It's a concern of mine. Predicting the future with certainty is certainly, it's just impossible, and anyone thinks they can do it probably needs to have a conservator appointed to manage their money. Ask yourself why a BBB+ rated 10-year government bond issued by the Greek government has a significantly lower yield than the U.S. 10-year, which still has a AAA rating from one of the credit agencies. There's a website called World Government Bonds, run all that together as one long word, .com, that has the current yields of bonds issued by world governments. The 10-year Greek government bond is at 3.09% when I last checked earlier this morning. Almost every developed country in the world has a 10-year bond yield lower than the U.S. I don't think that has anything to do with credit risk. Maybe credit risk will develop a few decades down the road when the Fed, what I anticipate to be failed treasury auctions, start to occur. The higher U.S. 10-year yield now is being caused, in my opinion, by excessive supply, which is in a parabolic increase mode. The budget deficit for the fiscal year ending September 30, 2024 was at $1.8 trillion, up from $138 million from the prior fiscal year. So the supply problem is becoming a lot worse and is parabolically becoming worse. I will cite the monthly budget review by the Congressional Budget Office on those budget deficit figures in the More section below. I would add that in 1981, the entire budget debt, the entire debt of the United States government was less than $1 trillion. And now we have budget deficits of $1.8 trillion annually.